Good morning. My name is Jonathan Gould. I'm the 32nd Comptroller of the Currency. Although I was sworn in less than a week ago, it's great to be here. And I look forward to engaging on these very important issues going forward. I greatly appreciate the range of perspectives and views that are being presented here today. And I thank the Vice Chairman for Supervision for her efforts in this area and her invitation to attend today's event. One of my areas of focus as Comptroller is ensuring regulation and supervision are properly calibrated and appropriately focused on safety and soundness. To that end, I believe it is prudent to consider the appropriate risk tolerances and capital requirements that are required for the largest banks, and how these choices may impact other banks as well. This next panel is focused on the evolution of the capital framework, including what has come to be known as Basel III. This distinguished panel will share their thoughts on several topics of interest, including the global framework, tailoring, interactions with other prudential requirements such as stress tests, and the impacts on economic growth and financial stability. I'd like to thank our distinguished panelists for appearing today and would like to turn the discussion over to panel moderator, the inimitable Rob Blackwell. Thank you.
Thank you very much. Thank you very much, and thank you to Fed Vice Chair Bowman for having this conference. This is very exciting. I have a wonderful panel in front of us. I am not going to do justice to any of their biographies. That way we can get straight to the questions and presentation. But so that we'll give you a brief overview. Phil Evans, to my left, is Director of Prudential Policy at the Bank of England. As part of that role, he's in charge of implementing Basel Endgame in the UK, called Basel 3.1 there. He previously was in charge of coordinating the bank's work on the UK's withdrawal from the European Union. Shira Friedman is the Chief Accounting Officer and Controller for Goldman Sachs. As such, she is responsible for the oversight of external and internal reporting, product control, and regulatory capital. Randall Quarles is the Chairman and Co-founder of the Synosia Group, a Utah-based investment firm. He was the first person to serve as Vice Chair of Banking Supervision at the Fed, serving that role for 4 years between 2017 and 2021. Last and not least is Mike Mayo. He's Managing Director and Head of the U.S. Large Cap Bank Research at Wells Fargo Securities. He is the first analyst to testify on the causes of the great financial crisis, and he is representing himself, not the views of the bank. So I'm going to actually kick off right. I just want to make that clear from the outset. I'm going to kick it off, and you'll see why in a second. I'm going to kick it off directly to Mike, who's going to give us an overview, a brief overview, but very entertaining overview of how we got here. When we talk about Basel Endgame, what are we looking at, and how did we end up in this place?
Well, Rob, thank you, and thank you to the board.
The mic button. Sorry. Mic to the mic. Yeah, it's the button with the voice.
Oh, it's the bit with the mouth.
Yep.
Okay, there we go. Look what I found in the hallway as I came. Look, I love the idea of a regulatory reset. Let's keep banks safe and sound, but rip out as much bureaucracy and red tape as possible. And so I'd start with, first, thank you, regulators, for what you did after the global financial crisis. You made the system so much more strong than elsewhere around the world, and I'll spend 2.5 minutes on these. But the system today, it's too confusing, too constraining, and too costly. And when I worked here in this building 35 years ago, the capital rules were simple and weak, and today they are complex and strong, so let's make them simpler and strong. And I did a proprietary survey to institutional investors. Those are the largest pension, hedge funds, mutual funds around, and 9 out of 10 investors, these are the owners of the banks, find the capital rules confusing. There's too much regulatory risk. Regulatory risk wasn't even a phrase a few decades ago. There's other risks you have to contend with, not the 4 words that strike at the heart of investors. What will regulators do? There's too many targets, it's acronym soup, and too much capital volatility. It's too much of a black box. You don't know the cost of goods sold until after the fact. I mean, if you're selling steak au poivre and you don't know the cost of the steak till after that's a problem. look, nobody wants to go back to 2007, but right now the pendulum swung too far. Same investor survey, 9 out of 10 investors find regulation too strict. Too much marginalization of banks. If you look at loan growth by decade, the last few years it's been flat to negative, inflation adjusted. Too much disintermediation, marginalization of banks, too much business leaving the banking system, and too much disregard of de-risking. 15 years. You've done a great job, regulators, as of 10 years ago. You've doubled capital roughly. You've doubled liquid assets. Banks have not stretched for loan growth. But as I learned here, I learned my best lessons here at the board 35 years ago. If it grows like a weed, maybe it's a weed. Banks have not been growing loans like a weed. And look at what the $7 trillion investment-grade bond market says about bank safety. They're saying banks are safe. In fact, they've said banks are safe for most of the period for the last decade. And it's too costly. These are our best estimates, but roughly 20% of bank expenses are related to regulatory, compliance, cyber, all in. And then when we poll large banks, they think they could maybe save 10 to 20% of that. So you're looking at a possibility of saving 4% of expenses. And in our investor survey, what investors are looking for are greater efficiency from regulation and greater loan growth. And there's too many moats around the largest banks. Talk about unintended consequences. By the way, when I worked in the application, the merger group here 35 years ago, we would approve mergers in 60 days. And we had one review said I looked at 100 applications in a year or something. And the unintended consequence is, fine, I'll just keep increasing my price targets on the largest banks. We should have more trillion-dollar banks to compete against JP Morgan. Goliath is winning. They're gaining share. And then there's the loss of talent. For every executive that comes in the banking industry, 5 are leaving. Talent drain. So 10 unintended consequences, too much regulatory risk, complexity, targets, volatility, marginalization, disintermediation, expenses, loss of talent. But there's hope. Let's see if this works here. The hope is this. I had to bring children's scissors to fit through the metal detector in the airport. Well, this is the hope, okay? That's the hope. And the end result here then is just win, win, win. Regulators, you can have more efficient oversight. The banks, yes, they'll be more profitable, more efficient, but the customers will have better terms and more options. So with that, I was going to hand this over to Phil, who can describe how we got to the state in Basel III.
Oh, blimey, I think I'm going to be a bit less entertaining than that. So I thought I'd take this two ways, basically. So I talk first about the benefits of having a kind of an internationally aligned approach. What benefits does that give us in general terms? And then I'll get on to the specifics about why this Basel Endgame package is, why are we doing it? So on the general, and I guess this is one of the key points I wanted to get across today. I mean, I'm going to argue that international standards are things that we benefit from. The reason we do them is we get benefits. And there are many that you could talk about. The two that I would pick out are, in terms of, first, international financial stability. So we are and still remain so interconnected that when something goes wrong globally on financial stability, it affects everyone. And those costs are deep still. And the second is on the role of international standards promoting trade in financial services. So, large global banks have economies of scale and scope, and part of the way they get those is having similar rules across borders. So it's what allows domestic banks to operate abroad and foreign banks to operate domestically. So that's the general. What about the specific on Basel Endgame? So as Rob said, our version of that is called Basel 3.1. So we couldn't quite bring ourselves to call it Basel 4, and so we had like a tiny eeny weeny Basel 3.1. But my guess is we were looking for the same kind of comfort blanket that you guys were when you called it Basel Endgame. It's part of the post-GFC reform package, so it's the third bit. First two bits were about the quantum of capital and then the quality of capital. So quantum we've done already. So I don't think that the Basel Endgame package needs to be about the quantum of capital at all. What is it about? It's about measuring risk better, right? So the standardized approach we have at the moment, the standardized approach is always going to be blunt, but it's just very blunt, the one we have at the moment. And so we're kind of tilting it just so that it picks up risk better for the right activities. And that is important in its own right, but it also has benefits for competition, because one of the things that we feel strongly in the UK is that smaller banks have been unable to compete on low-risk activities because they're forced up the risk curve by this very blunt standardized approach. And so a big benefit is to improve competition. On the model risk weight side, we kind of lost confidence in that a bit. So we had these papers post-crisis where we were running experiments. We gave firms the same, exactly the same scenario, run it through your models, and they throw out completely different risk weights. And that kind of drains confidence. So one of the things we're doing in this endgame package, 3.1 thing, is a bunch of things to try and bring back some of that confidence again, so, through things like the output floor. So I'd argue there's a lot to like about international standards in general because they give us benefits, but this particular package is balanced and gives us some good things.
All right, well, thank you very much. As everyone in this room knows, this is not the first time we've taken a run at Basel Endgame. So I'd like to ask Randy to start off and give us a sense of what were the mistakes that regulators have made in the past? What are things that should be avoided now as they craft this again?
Well, I guess it depends on when in the past you're talking about. Because there have been a few efforts, and some were better than others, as it turns out. But so I think there are, with respect to what ought to happen in finishing the implementation of Basel III, I think there are substantive issues and there are process issues. The first substantive issue is that these measures, even in Basel, as Phil mentioned, this isn't about the quantum of capital, and it was not about the quantum of capital when these measures were being discussed in Basel. It's about the incentives that the overall capital framework is creating, and they were not intended to increase the quantum of capital, and I think that should be a first principle of implementation here in the United States, not just because it's sensible, it's also Basel compliant. It's not intended to increase the aggregate amount of capital in the system. I think, and there have been proposals around implementing Basel III that would have done that, and I think that, I think that was the wrong direction. As a matter of process, I think it is a mistake not to get as much input as possible. And so this conference is a paradigmatic example of how one ought to go about the process of the implementation of these last measures of Basel III. From all sorts of areas. More heads are better than one. I think there have been folks who have said, look, here's a proposal. If you don't like it, vote no. And that's, it is a better process to have gotten input from everybody in this room, folks outside of this room, academics, banks, public interest. I think banks are part of the public interest, but a wide range of groups. And I think if you combine those basic principles, then there can be a successful result. I would add that I do think there should be a successful result. I've heard, there have been threads over the course of the last several months that maybe we just drop these last measures of Basel. And I think that's not in the interest of the United States. Bill makes a good case for, global financial stability. I used to be a global financial stability guy. I have nothing against global financial stability, per se. but the Basel process, particularly the Basel capital process, has really always been in the fundamental interest of the United States. Hal Scott mentioned that the very first Basel was because the Japanese banks were being allowed to operate with $12.73 of capital, and they were hoovering up all the business in the world, literally all the business in the world. Those of you with gray hair around here will remember the late 80s, and it was like US banks could not compete because the Japanese banks did not need to have any material amount of capital. And so the first Basel effort was to say, globally active banks will have globally consistent capital levels. Now that was, it was crude and simple, but it was a first effort. Then during the 90s, the European banks were operating with much less capital than the American banks, and so Basel II was this complicated effort to create an intellectual framework that would justify allowing the US banks to lower their capital to the levels of the European banks. The math club went to Switzerland. It was extremely difficult to understand, but people felt confident at the end that the capital could come down. No sooner was that done than you had the great financial crisis. Whoops, wrong direction. Capital needs to come up instead of down, and Basel III has been ensuring that particularly the Europeans, but global capital levels in general, are consistent. If you don't like what's coming out of Basel, what I say to the folks who wear my political football jersey, who believe that we go into these fora and are snookered by the wily Europeans, it's like, that's not what happens at all. If you don't like what is coming out of Basel, it's because you don't like what the US took into Basel. We generally get everything we want out of Basel in order to create this level playing field. And if we didn't have Basel, we would all be subject to these same rules because that's what we took in. And the rest of the world would not. So I do think it's very important that following these principles of not increasing aggregate capital, doing it in a sane and smart way, getting a lot of input on the technicalities, that we do finish the implementation of Basel.
Well, thank you. Shira, do you want to weigh in on where you think the mistakes were in the past?
Sure. Thank you very much. And I agree with everything that my other panelists have said. I think it's important to take a step back in light of the history journey that Randy just took us on and recognize that what is attempting to be done in Basel III Endgame is what's transpired over the last 4 decades and 4 iterations of changes to the capital framework, in that it addresses every component of the risk-weighted asset calculation and the ratio construct themselves. So it's a significant book of work, and some could argue the most significant book of work. And in my mind, there were 2 flaws in the design of the original NPR, both of which relate to isolation. The proposal was done in isolation of the other components of the capital framework, and the proposal was done in isolation relative to what was being done internationally. So as it relates to the capital framework, what's unique with the United States relative to every other major jurisdiction around the globe is that the stress capital buffer is a Pillar 1 requirement, which means it's included in your capital ratio requirements. And therefore, when you're going to overlay Basel III Endgame with the stress capital buffer, you need to be extremely mindful of the capitalization included in each affecting the same asset class or markets or products. And it didn't appear as though, based upon how the NPR was proposed, that that was done to a sufficient level. So that's one component of where it was done in isolation, and I think didn't calibrate correctly. The second is it was done in isolation relative to the rest of the world. And there are components that was included in the NPR that no other jurisdiction in the world implemented. So for example, the SFT minimum haircut floor was included in the NPR. No other jurisdiction has implemented it. The public listing requirement to get an investment grade rating was not implemented in any other major jurisdiction in the world. And so as a result, it's not surprising that 97% of the responders to the NPR were against it in some way, shape, or form. So the good news, and part of it is the energy that you're feeling in this conference, is the Federal Reserve has the opportunity to repropose Basel III Endgame, and I agree with Randy's statements that it should be on the docket of the many things that Vice Chair Bowman needs to do. But the good news is Vice Chair Bowman specifically has discussed the importance of looking at capital holistically and the relationship between all the different components. And then from an international perspective, because most jurisdictions are further along in implementing Basel III Endgame, you know the answer as to what every jurisdiction around the world has done, and that can kind of start as the blueprint as to how the Federal Reserve wants to repropose.
Well, thank you for that. I think since it's entitled The Evolution of the Capital Framework, I want to know what would a successful Basel III Endgame final rule look like? I mean, how would we know if we'd succeeded in what we're attempting to do here?
I'm happy to start, and others can weigh in. Every time a new capital rule is put into place, whether it's in the US or internationally, what essentially is being balanced is safety and soundness versus growth, innovation, capital markets, et cetera. And so in theory, you're weighing, and the regulators are weighing those two things in making all of the decisions around capital implementation. And so to the extent that the only thing you cared about was safety and soundness, you could make banks hold infinite amounts of capital. And as a result, you wouldn't have to worry about safety and soundness. But what would be the other side of that? Corporate bond underwriting would come to a screeching halt because there would be nobody available to underwrite. Corporations that want to hedge their interest rate risk or their commodity risk or their FX risk have no counterparties that they can face. Mortgage lending, credit card lending, et cetera. And so it's really about striking that balance between economic growth and safety and soundness. And so when you look at the way in which most other jurisdictions have implemented Basel III Endgame, they've really tried to achieve that balance. And in some ways, it comes back to that capital neutrality point. And so there are certain components of the rule that they've implemented that incentivizes economic growth. As an example, most jurisdictions have exempted end users from the CVA add-on included in Basel III Endgame. And that's to protect those corporations from the burden of the banks carrying increased capital associated with facing them as a counterparty. Many jurisdictions have not applied the 400% risk weight to public equity, to private equity, to all private equity, but limited it to speculative private equity so that banks can continue to participate in more mature private equity, which is often on the precipice of them ultimately becoming public equity. And so to me, a successful Basel III Endgame has appropriately balanced safety and soundness, which is obviously incredibly important, but also economic growth.
Randy, do you have a view? What does success look like?
I think that was a pretty good overview of what a successful implementation would look like. The purpose of these last measures is to create incentives with respect to bank activity without increasing the capital burden, if you will. And I think if you see bank activity modifying appropriately in light of the areas where these new capital requirements are being implemented, in a way that is supportive of economic growth, but you actually see, okay, well, the banks are changing their, we have in fact created incentives. We're seeing that the incentives are operating appropriately, and we haven't increased the overall capital burden on the system. That's a success.
Phil?
Yeah, I mean, the best way for me to answer that is to couch it in terms of the way we tried to construct our own implementation of this. So I guess there were three things. So one was from the bottom up, activity by activity. We weren't looking for too little capital, but we weren't looking for too much either. So a kind of fair amount of capital, if you like. And then top down, we had a view that there was enough capital in the system, so this wasn't meant to be about looking for more capital overall. And then third, we were looking for international consistency. So we were monitoring what other countries were doing. So what does a good one look like? I think it looks like those things coming through. So the playing field looks level. We've got consistency across jurisdictions. We're looking to make sure that capital isn't rising. So one of the things we'll probably get onto this when we talk about stress testing, is we had a principle from the beginning that we shouldn't double count. So if there was something where we were holding capital previously in some part of the stack, and now Basel 3.1's coming in and you're holding it in Pillar 1, and it's the same thing, then you don't need to hold the capital twice. And that was a principle that we tried to build in from the bottom. It's easier said than done sometimes, so it's not always obvious what is a double count. Final thing I'd say, so I do think there's something in this for small firms. So the risk sensitivity that I mentioned, I think, is a good thing for small firms on the standardized approach. And I'd like, so I think we'd be looking for in our implementation just a bit of the leveling the playing field between small and large firms. That's it.
And most importantly, less loans to the shadows.
I think one of the things that, Randy, you just touched on was this idea that what happens if the U.S. doesn't complete Basel III Endgame, and there have been some lawmakers who are concerned about the international framework as if we're deferring to international regulators of what to do here. So let me just ask each of you, what happens if the U.S. just decides not to implement Basel III Endgame and lets it go?
Yeah, an important question. I mean, I guess the first thing to say is I hope that doesn't happen because so speaking for the UK, we get tremendous value from our close collaboration with our US counterparts. It really does make a difference to have the US as an integral part of the international community. I guess a bit more concretely though, so I haven't really seen evidence of that. That it's particularly likely. So my reading of the consensus is that it doesn't seem very likely. And I guess at one level, I don't find that surprising because in the way Randy and I have tried to describe the benefits of kind of being similar across jurisdictions is good for global financial stability. It does help with leveling the playing field. And, these are all things that we recognized, that the US recognized when this was being negotiated in the first place. So I'd argue that banks, large US banks, as well as UK banks, benefit from that consistency. So you'd want to do it, I think is what I'm saying. So all of that explains why we're a long way down the track in terms of our implementation. But so, I mean, given those arguments, if the US really didn't implement, obviously that would be a major issue. And I think it would be wrong to deny that it would be a major issue. So although I think there are strong drivers to get Basel Endgame done, we'd have to cross that bridge when we come to it. But I know the US authorities that we speak to anyway understand that very well.
Sure.
Yeah, I was just going to kind of agree with my panelists. I think that although my perspective is obviously different as a practitioner, the importance of having the banks around the world on a similar and consistent capital framework, recognizing that it can be gold-plated in some jurisdictions versus other, and on all things that need to be addressed and discussed, that I do think that it's important that the U.S. implement Basel III Endgame to be consistent with the other banks around the world.
Randy, anything to add to what you said earlier?
Yeah, I think the principal consequence would be when we get to Basel IV, which we will. There will be new issues in the future. We will learn things about the financial system will evolve, the banking system will evolve. There will be a need to evolve the capital framework in light of that. Other issues will arise, and we in the United States will once again say, if we want to have a fair playing field on which to compete, there are some changes we need to make, and we want them to be made consistently. And if we have not implemented Basel III, which was very much driven by the United States, we will walk into that room and people will be much less willing to listen to us since we were the Lucy that pulled away the football the last time.
Mike, do you have anything you want to add?
Get it done, get it done, get it done. If you don't, then the cost of capital for banks would be higher than it otherwise would be.
So I want to spend a little time. There's an entire panel about the stress test, and I don't want to steal their thunder. But I do want to talk a little bit about the interplay between Basel III Endgame and the stress tests and what the relationship should be. So, Shira, let me start with you. What should the relationship be between this?
Sure. It's a great question, and it's something that gets a lot of discussion. As I mentioned earlier, the U.S. is unique in that the stress capital buffer is part of our Pillar 1 requirements or part of our ratio requirements, and therefore requires a higher degree of sophistication when combining that with Basel III Endgame, because you have everything that's been capitalized in the CCAR stress test, and then you have things that are being capitalized for in Basel III Endgame, many of whom are double counts across them. So in my mind, the most egregious example is operational risk. In the results that the Federal Reserve released last month on the CCAR stress test, they included $180 billion of capital associated with operational risk losses on the banks that participated. And so therefore, that $180 billion has been capitalized for in the bank's ratios. When included in Basel III Endgame, it reintroduces operational risk into the risk-weighted asset framework. Currently, today, that only sits in the advanced ratio, so it's not part of the standardized ratio, which is the more binding ratio for the banks. And so included in Basel III Endgame is operational risk-weighted assets. In the estimates that the banks provided in conjunction with the NPR, the amount of capital associated with those operational risk RWAs was around $150 billion. And for those that don't know, operational risk is capitalizing for, generally it's legal losses, that's kind of the biggest driver, but it includes any sorts of costs associated with outages, climate-related events, et cetera. It's all captured in there. So when you take the stress capital buffer loss of $180 billion, plus Basel III Endgame RWAs of operational risk, which is around $150 billion of capital, what the original proposal did is just put those two numbers on top of each other. And so the question that every constituent should ask is why is it necessary for banks to hold $180 billion plus $150 billion of capital associated with operational risk? And if you look at history and just focus on the GSIBs, over the last 10 years, so decade, the GSIBs, and I can only speak to legal losses because operational risk losses are not in the public domain. The GSIB legal losses has not been $180 billion. It's not been $150 billion. It's been less than $100 billion. And that's over 10 years. The CCAR stress test is only 9 quarters. And so I use that because, again, I think it is the most egregious example, but you can look at market risk, you can look at CVA, you can look at lots of different components. And the challenge for the Federal Reserve is to look at what's being capitalized for in the stress capital buffer, which is unique, and what's being capitalized for in Basel III Endgame, and making sure that they're not double counting things.
Randy, the stress capital buffer was finalized under your watch at the Fed. Can you take us through why it's better than the CCB was and why it's needed now?
So I think that there are two parts to that answer. One is a legal part, sort of general legal principles part, and the other is a practical part. So before the stress capital buffer, and I hadn't realized this until I walked into, well, it wasn't this building, it was the one across the street, which now may never be built, but before the stress capital buffer, the outcome of the stress test, the practical outcome of the stress test, depended on what the Board of Governors had had for breakfast on the morning it was presented to them. And that does not seem to be the right way to operate a regulatory system. That's going to have such consequences for the regulated. So the basic legal principle, it seemed to me, was that the consequences of the stress testing process should be clear and concrete and measurable. They should be legal as opposed to entirely discretionary. And I should state that I'm a big fan of stress testing. During the COVID event, the fact that we had stress tests, and we ran 7 stress tests in the United States during that period, allowed us to be very confident in the resilience of the banking system during that whole time, and allowed us to continue to allow our banks to pay out dividends when the rest of the world had suspended them. And our banks are benefiting from the lower cost of capital that comes from that predictability of return even today, many years later. So stress testing, good in general. But there should be a predictable outcome. The practical side of the question to me for the SCB as well is that if it depends on what you have for breakfast, different people at different times have different breakfasts. And the potential consequences of the same stress testing outcome, depending on the particular people who have been appointed to the Federal Reserve at any point in the future, could be dramatically different. If you've left that open, you've essentially left it open to the vagaries of the political process if you don't have a concrete consequence for the outcome of the stress test. Over a long period of time, the Fed is a marvelously apolitical institution. As a citizen, I've been very, very pleased with my involvement with it to see how true that is. But the people are appointed through a political process, and over a period of time, you could have significantly different outcomes for the industry. So I think both for general legal principles of regulatory action should be subject to discipline, and the stress capital buffer makes it clear what that discipline is, and and predictability of results over time. That's how the outcome of the stress test should be implemented, is through some sort of a stress capital buffer.
Mark, you look like you have something you want to
Well, I
add.
just want to put an exclamation point for what Randy said. I mean, having had the stress test in April 2020 or spring of 2023, we felt confident, I think a lot of investors felt confident that banks could withstand whatever was coming their way, the largest banks.
If the agencies agree that the fundamental review of the trading book plus the GMS and the stress test hit bank trading books with excess aggregate capital requirements, what is the best path to reducing that surplus? Should we soften the GMS or look to soften the FRTB domestically or in Basel? Shira, you want to? I'm gonna volunteer you because you have the red light on your microphone.
I heard FRTB, and that's like magic to my ears, so I figured it was coming my way. My takeaway from Randy's talk as to relates to how the SCBs are derived is that I should have gone to culinary school instead of becoming an accountant. Would have been better for Goldman Sachs. But with that said, the FRTB, and for those that don't know, that stands for Fundamental Review of the Trading Book. That's the market risk component of Basel III Endgame. And the Global Market Shock, or GMS, which is included in the CCAR stress test, is the instantaneous shock to the trading businesses of the largest banks. And so your question underlies the issue at hand, which is that there's a duplication between how FRTB is shocking market risk and capital and requiring capitalizing for market risk versus the GMS. And if you dig even deeper, they both kind of do it in a similar-ish framework. They're both looking at the same position set, and they're looking at tail risk, so they're shocking it to like the very tails in terms of how those markets would be affected. And then, again, in the original proposal on Basel III Endgame, stacked those two things on top of each other. And so to your question, to the extent, as the Federal Reserve is looking to repropose Basel III Endgame, as well as, all the work that's being done on the CCAR process, I think both stand to benefit from a really deep dive to ensuring that the shocks and the assumptions and liquidity horizons that are being used in them are consistent. And I'll use an example that I think highlights it. The GMS still uses assumptions from the financial crisis in terms of the level of shocks, despite how far we are removed from the financial crisis, and more importantly, how much reform has happened since the financial crisis. So as an example, using securitized product, so this is the underwriting and packaging of mortgage-related or asset-backed or CLOs, taking all those assets together and issuing them as bonds. The shocks that the Federal Reserve applies in the most recent CCAR stress test, so the one that we just got the results of, are equal to the shocks that banks, that those assets suffered during the financial crisis. What that doesn't account for is the fact that the LTVs of those loans are significantly different. the FICO scores of the borrowers are significantly improved. And so the shocks are being applied to bonds and assets that are much better underwritten or subject to much better underwriting relative to the products that were being traded in the financial crisis. And so I do think that the GMS is very ripe for that, to get that overhaul, because it really hasn't been addressed, since it was first put in place. And one of the ways in which the calibration is off is to the extent that you take an asset, a securitized product, and subject it to both FRTB and the GMS. About 15% of the product that was underwritten last year, banks would be required to hold more capital than the carrying value of that asset. So I would have a bond with a carrying value of $100 million, and if I added FRTB and the GMS to it, I would capitalize that for $120 or $130. So the capital that I would hold is greater than the carrying value, such that if I wrote that bond down to zero, I'd actually release capital. And so it's an example of where you can look at it quite simply and see that the calibration is off. And as I mentioned, this isn't one or two bonds. This is 15% of the market that was underwritten last year.
So one of the arguments that Treasury Secretary Scott Bessent brought up last night was talking about whether or not firms should be able to opt in to Basel III Endgame, those that are not covered by it. And I guess I want to get the panel's view on, are there pros and cons to including them versus not allowing them to be included if they want to, and what the system looks like?
I'm a libertarian. And I'm nobody's mother. I mean, if they want to opt in, I don't see a downside, except potentially from the institution, and that's theirs to judge.
Phil?
Yeah, so this is a question about whether you apply the rules to small banks. So Basel 3.1 was agreed internationally, so clearly applies to the largest banks. I've argued that it's better than what we have now, so I think you'd want to apply it to mid-sized banks for us. The question is, do you apply it to the very smallest banks? So in the UK, we've long wanted to have a kind of a more proportionate regime for smaller banks, and now that we have left the EU and we can write our own rule book, we've been working on that. So we call it Strong and Simple. In homage to Mike. So we had to decide whether to take Pillar 1 from Basel 3.1 and give it to the very smallest banks. In the end, we decided we would because we just felt it was better. We felt it enabled them to compete more. The caveat was that where we saw that there were parts of the new Basel framework where they just didn't need the rules because they didn't do much of it, like trading book rules, CVA, counterparty credit risk, all of that kind of stuff. We said, you don't do much of that. That's how you got into the Strong and Simple regime, and so you don't need to worry about those rules. So we carved them out of that, but the rest of it we did. So we have. I think it is possible to give the Pillar 1 to smaller banks, and I do think they would benefit from it.
One of the things in my former life when I was editor at American Banker, we used to talk a lot about capital standards always inadvertently pushing banks out of different activities. So, can you talk about the extent to which there are dangers in Basel III Endgame of doing that versus, how can we morph capital requirements to bring some of the activities that were in the past possibly pushed out by these capital requirements back into the system?
I'm happy to start, and others can weigh in. I think that your question is 100% right, and we've seen it time and time again. No matter how big or how small the rule is, as the capital framework continues to evolve, you're able to pretty clearly see the impact of what it does to the broader market as a result. So when mortgage lending related requirements were gold-plated, immediately thereafter saw an uptick in the amount of mortgages being underwritten outside of the banking system. Most recently in the implementation of SACR, which is the counterparty credit capitalization requirements, which is actually part of the Basel III endgame, those rules changed the capitalization for short-dated derivative hedging. And as soon as that rule came into play, you started to see that activity move outside of the regulated banking system. And so that unintended consequence of the amount of activity kind of almost immediately responding. I mean, you even see it in CCAR shocks, where if in a particular year the Federal Reserve shocks are more punitive to something specific from an asset class perspective, you will see banks will do less of that, and it will move outside of the regulated banking system. And so that's something that needs to be really carefully thought about in conjunction with all the components of the capital framework that the Federal Reserve is looking at, whether it's the stress test or Basel III Endgame or GSIB, that to the extent that you're increasing the capital requirements on particular products for the most highly regulated banks, that activity will go somewhere, and it will go out to the less transparent outside of the banking system.
Randy?
Yeah, I do think that is something that has heretofore across a broad range of eras and people and regimes been given insufficient attention in thinking about bank regulation. Is that especially in the United States, but now really even very substantially globally, it's a financial system. It's not just a banking system. And if we adopt regulations that are going to push something out of the banking system, it will go elsewhere. We will not really constrain that activity. You have to think, and we will push it into either parts of the financial system that are less transparent and less well capitalized, or jurisdictions that are less transparent and within the banking system that are less transparent and less well capitalized. So, and there really has not been sufficient attention, I think, given to that holistic view. The growth of private credit in the first instance was really driven by regulation. I think it's now growing for reasons that are outside of regulation. I think actually there are reasons to think that the growth of private credit is probably stability enhancing because the vehicles through which private credit is provided are less subject to runs, and an ecosystem is developing where the banking system and the non-bank private credit system are working together in a way that allows more visibility from the bank regulators into the overall financial system. I think it's working well now, but there's the fact that it's working well, there's no particular reason to have driven it out of the banking system, and the bank regulators should think about, if a bank can do this lending safely, it should be allowed to do it safely, even though the private credit system is not, in fact, I think, harmful in any way.
Well, we have a brief few minutes before our panel ends, so I have more than enough questions that I can keep going, but trust me, question right up here in the front.
Thanks. I want to take us back to some of Mike's slides in the beginning, where you painted sort of a picture of utopia, a city on the hill that would be both strong but simple. So if you were going to try and move us from where we are today towards both simplicity and strength, are there one or two things you'd say these would be the best moves to get to that city, both for Mike and for others?
Well, I call it balls and strikes. I don't set policy. So I'll let you know once I see it. But when I talk about it being confusing, it's not just confusing to investors. I bet it's confusing to bank board of directors too, and bank execs, and frankly, probably some regulators. When I talk about it being constraining, let's banks be banks. When I talk about it being costly, I mean, that's an easy one. I mean, we all see examples of that. But I think, two themes have come up. Certainly holistic approach to capital. Second is the idea of level playing field. But I'd add a third one, and that would be dynamic regulation, because we're going to have more bank failures. There's going to be more bank crises. That we all know that, but they don't repeat, right? You had lending to South American countries, and then you had commercial real estate, and then you had long-term capital, and then you had global financial crisis, and then you had Silicon Valley, and the next one's going to be different. So I like the idea of having examiners also being accountable in a decentralized way, as opposed to ivory tower academic setting models. So I think a degree of humility about what we can do. And when I was here 35 years ago, there was Bill Taylor, who headed bank supervision regulation. He was the best. And he was like, be tough on the things that matter. That's capital, that's liquidity, that's what keeps you solvent. So that's my template for it, but I'll leave it to the ones who practice and do these things for the policy.
The good news is, we're having a conference like this, like we've never had before. And when you look at what Vice Chair Bowman's done over the course of the last few weeks, it's more change than we've kind of seen in both the recent past and even longer. I think focusing your question particularly around the CCAR stress test, we are pleased with what the Federal Reserve has done thus far in terms of enhancing some of the disclosure around the tests, and also talking about their willingness to put the scenarios and the models out for public comment, because we think that transparency is really important. As the firm with, I would argue, probably the most volatile stress capital buffer, I agree with Mike's points. You can imagine capital planning is very difficult when your requirements could change year over year by north of $10 billion, even though your business model is relatively consistent. And although the averaging NPR is meant to address that volatility, it doesn't actually address the fundamental or the root cause of the problem. The root cause of the problem is the scenario and shocks, which we've talked about, that really haven't been calibrated for all of the regulatory reform, the Volcker rule that we talked about in the last panel, mandatory margin and clearing, and all of this uplift that's been done to the regulatory environment, such that the shocks that existed in the financial crisis shouldn't be the shocks applied today. And then the models, again, we don't have full transparency around them, although we look forward to that, don't respect some of the observed correlations that exist that we've seen it happen time and time again. Example around trading revenues. All the most recent crises have proven that in times of volatility, trading revenues increase because there's more activity and bid-offer spreads widen. Nevertheless, when the Federal Reserve models trading revenues in stress, they don't include that assumption. And so I think that we're on a really great path, but that's some of the more particulars that need to get addressed.
Jarrett, over there.
Yeah, hi, Jarrett Seberg with TD Cowen. I'm going to regret saying this on camera, but I actually agree with Mike that I think most of the market doesn't understand bank capital rules. And I think we run into a problem where there's such a push for tailoring. We hear that over and over on Capitol Hill. But that means that we have even more sets of rules, and we don't quite know which banks apply, are covered by which sets of capital rules. I wanted to focus in particularly on available for sale securities and whether those unrealized gains and losses should run through capital. I was hoping the panel could talk a little bit about why that's only for the biggest banks, and should it be pushed down to all banks?
That's a good question. Does anyone want to jump in there first?
So it's, I probably shouldn't have pushed that button because it's been a few years since I engaged on the question. But it's harder than it sounds because to the extent that you push changes in the available for sale securities account through capital, then you create a strong incentive to move those securities to the hold-to-maturity account. And once they're put in the hold-to-maturity account, they are, as a practical matter, quite illiquid. So when the Federal Reserve, this was long before my time, this was under the sainted Dan Tarullo's time, considered this question, that incentive was very important in saying, okay, well, we shouldn't do that for most banks in order to create this kind of incentive for structural illiquidity on what should be liquid securities. Of course, the problem is that those available securities do change in value, and that can have a capital effect. If you take, however, Silicon Valley Bank just as an example, where that was the most recent instance where this issue was considered, and people said, well, why shouldn't we have been requiring them to increase capital as the value of their securities was increasing? Actually, if you'd had such a rule, that would have created an incentive for them to push much more of their available for sale securities into the hold-to-maturity account, and it was the fact that they had all of these securities in the hold-to-maturity account that was concerning, because they couldn't liquidate those, and it was that overall position that was causing the concern about their overall solvency. So you actually would have worsened the Silicon Valley situation, most likely, by creating that incentive for them to put even more of their liquid securities into hold-to-maturity. So, how do you address that? Well, you could say, all right, well, for banks, we're going to require you to take the changes in value of both of those accounts into account for your capital. But a long time ago, the bank regulators decided, I think on balance correctly, that the regulatory accounting regime had diverged so much from the generally accepted accounting principle accounting regime that it was now that there were a lot of pathologies associated with that, and that the bank regulators would rely mostly on the on FASB standards for determining what what would be income, what would not be income. I think that's still correct. People have gone to FASB for a long time, even outside of the banking rules, to say that hold-to-maturity securities should be treated differently, and they have decided not to. Again, because it's not as simple a question as it sounds, and so until they do, I think that I think that that balance that's currently being struck about what to do with accumulated other income or what to do with the treatment of available for sale securities is two ways of saying the same thing is correct.
Well, unfortunately, we are at time, but I want to please join me in giving a round of applause to these panelists. Thank you so much for being here. Thanks again to the Fed.